We'll focus now on the consumption space now. Saugata Gupta, Managing Director and CEO at Marico, says the worst is over, but urban consumption has been stressed. My colleague Mangalam caught up with Saugata Gupta and began the conversation by asking about the growth trajectory for the company.
If you look at the total environment, over the last couple of quarters, rural is improving. Urban consumption has been stressed. Having said that, we believe that the worst is over. It will gradually improve. Obviously, the improvement will not be, like a hockey stick kind of a U-turn, but it will improve definitely. Now, I think as far as Marico is concerned, 2-3 things I would say was slightly different. One is, of course, our significant focus on our diversification and transformation of our portfolio to make it future ready. If you look at around 2020, the composition of food plus digital plus premium personal care was around 6%. Today it's 21%. So that is giving us that growth. The second thing is that we have been also not been cutting A&P to manage margins, but doing a far more institutionalized cost management program. Thirdly, some of the issues in the system we called out pretty early. For example, things like GT being under stress, the fact that there is a potential channel conflict, investing ahead of the curve in new channels, and of course the fact that if FMCG companies don't actively participate in the D2C space, they are likely to get squeezed out at the top of the pyramid. So I think some of the things we have taken proactive steps, and therefore that has resulted in that we are still being resilient in this situation.
So 6% volume growth is what you reported this time around. How far are you from the 10% mark? Because it's a function of what you're doing and it's a function of what the environment is doing as well. Rural you called out as improving. Urban may not be hockey stick. What does the very near future and medium term look like for you?
So I think it's very difficult to say when will 10% happen. I think the question is that we have, if you look at sequential quarter, we moved from 2, 3, 4, 5, 6. That's been the kind of a movement. I think a mid-single digit is something which is eminently possible. Our endeavor will be to gradually move that to, high single digit. I think 10 is something which, again, is something which will depend on the environment and other factors. But as of now, I think our aspiration is how do we inch this up a little bit. I think what we are more confident about is, given there is a bit of a, pricing equation that is there, to deliver double-digit revenue growth quarter after quarter over the next couple of quarters. And that's something which we are pretty confident about. Our endeavor obviously will be to continuously try and deliver top quartile volume growth.
What about the margins? Because your anticipation was 20.5%. You fell short of that by about 150 basis points. That was largely on account of the sharper than expected inflation that we saw. Where do we see that going?
So I think the inflation cycle will continue for the next 2 quarters. Okay, so as far as the copra is concerned, we are broadly at the fag end of this inflation cycle. It's usually 18-month cycle. We expect things to improve sometime towards the end of quarter 1. So obviously there will be a lag and things will start improving from quarter 2. As you know, in edible oil, there's been a 20% duty, which is something which obviously has resulted in some kind of an inflation. I think as far as margins are concerned, there will be a situation where the first 2 quarters will continue to have some impact, but it will start easing off towards the second half of the year.
So how much lower can they go before they go back to that 20% mark?
I think we are in that zone right now. I don't think there will be a significant squeeze beyond this. But having said that, I think our endeavor will be to move it to 20 as we,
But then you'll have the leverage coming in from all your new brands, etc., where they are improving their operational parameters as well, right? So would there be significant growth in margins beyond that 20% mark, or you believe in, passing on the benefit to the consumers and hold your margins around that 20% mark?
So I think value to the consumers is important because we have taken some significant price increases. Similarly, as far as the digital and the new business is concerned, obviously our endeavor is to continuously improve margins. So to give you an example, if I look at the oats plus masala oats business, which is core of the current food business, that delivers an EBITDA close to the company EBITDA. Okay, I think I would say there will be 2 milestones. One, can we get the digital business, which is a very high growth business, to get into a double-digit EBITDA? Beardo is already delivering that. Plix is positive. There is a bit of a cash burn in terms of the other 2, which is True Elements and just out, but it's minor, it's not major. And then, so I think as long as, and we are much more comfortable with say a 30% growth with continuous improvement in profits versus delivering a 50%, 60% growth with a high cash burn model. Okay, food is also improving, so I think the margins will creep up, and I think even in our international business there are opportunities for scale-driven margins. But as you see, we are in emerging markets. When we operate right through, in our international business and India and emerging markets, India, and the focus is to invest to grow. It is about getting new consumers. It is about getting existing consumers to consume more, grab market share, and continuously diversify.
One thing that stands out is that in all the traditional FMCG companies, you've been among the first few to get onto this D2C acquisition bandwagon. So 5-6 years into this acquisition bandwagon, if I had to ask you a couple of questions, what is it that you learned from them, and what is it that you taught to them, and as a result of which the synergies were created? How would you reflect upon that?
I think three things. One is digital marketing. I think something which we have really learned and tried to improve our capability in that. The second thing is high velocity innovation, risk taking, and ability to gather insights from the environment and quickly launch. So it's about think big, start small.
Could you give me specific examples?
I think if I look at the innovation cycle compared to a traditional FMCG company versus say some of these D2C companies, it's severely crunched. They are happy to take small bets and risks because the risk appetite, I would say the risk appetite is high, but I think the value at risk is always low. I think what they have learned from us, I think, is cost management, governance. I think also a little bit of framework for choice making, because unfortunately in some of these companies, I'm not talking of our companies, but we have seen some of the startups, it's about spray and pray.
Yeah.
I think that ability to do sharper choice making without analysis paralysis, right, and something which they have learned from us.
And what about the threats? What do you think would be the potential
threats? I think the 2-3 threats obviously is that core slowing down. I think whenever there is significant pricing interventions, and if I look at volatility of raw material, commodity, and therefore we are actively ensuring that we de-risk ourselves from commodity dependence.
How much has it de-risked? Ever since you joined, I remember over 60% of your revenues would come from...
I think there's been a significant de-risking, and we still want to continue the journey. And I keep on saying that my aspiration or ambition is that we do an analyst call 3-4 years from now where copra is not discussed.
Okay, that's an interesting one. So how much do you think have you decommodified your business? Not just copra, but even edible oils?
Yeah, so as far as edible oil is concerned, I think what we have said is that the growth of the Saffola master brand has to be through foods.
Yes.
And again, in foods, we are cherry picking categories which have higher margins. I mean, there's always a temptation to get into things like rice, pulses, and spices and all, which will give me quick growth. Yes. But we have resisted the temptation to do that, because I think one of the things we said that the food business should be far more margin accretive, and maybe 3 years from now, food will be bigger than edible oil in the Saffola.
50-50 was your target, I remember. Where does that number stand right now?
It's still around 30-70, 35-65, it hovers around that. But it should be 50-50 very soon. And maybe 3 years from now, we should be a higher food business,
Interesting conversation there. He hopes that in the future, at some point, the conversation does not center around, parachute and the prices over there.